If you are losing money consistently, it is not because you lack entries. It is because you lack respect for risk. Fix that, and everything else becomes easier to see. Most traders are not defeated by a single bad trade. They are defeated by a sequence they were never prepared for. This chapter is where illusions die, because here we confront the mathematics of risk, not the fantasy of outcomes. The market moves in probabilities, not promises. And probabilities express themselves through distribution, not fairness. Wins and losses do not alternate neatly. They cluster, they streak, they arrive in patterns that test emotional control. If you do not understand this, you will always misinterpret what is happening to you. This leads us to the seventh law of risk management. Drawdowns are not a failure. They are a feature. Most traders treat drawdowns as evidence that something is wrong. That mindset alone destroys them. Because once you believe drawdowns should not exist, you will constantly interfere with your system to avoid them. But every profitable system has drawdowns. Every single one. The difference between professionals and amateurs is not whether they experience drawdowns, it is whether they planned for them. A drawdown is simply the cost of doing business in probabilistic environments. It is the rent you pay to remain in the market. When you design risk incorrectly, drawdowns become emotionally intolerable. When you design risk correctly, drawdowns become boring. And boredom is where consistency lives. Here is the truth most traders never accept. You are not trading to win today. You are trading to survive a series. A single trade outcome means nothing. 5 trades mean very little. But 100 trades executed with consistent risk begin to express expectancy, which brings us to the 8th law. Expectancy matters more than win rate. This is where beginners get trapped. They chase high win rates because it feels safe, it feels controlled, but a high win rate with poor risk reward is a ticking time bomb. You can win 7 trades in a row and lose everything on the 8th if your risk is undefined. Expectancy is the mathematical expression of your edge. It answers one question only. Over time, does this behavior produce positive results? Expectancy does not care about emotions. It does not care about confidence. It does not care about how you feel today. It only cares about 3 variables: how much you risk, how much you make win right, and how often you are right. Most traders obsess over frequency. Professionals obsess over magnitude. A trader with a 40% win rate and strong risk reward can outperform a trader with a 70% win rate and weak structure, but only if risk is controlled. Without risk management, expectancy collapses. This leads us into the 9th law, which is subtle but lethal when ignored. Winning streaks are more dangerous than losing streaks. Losing streaks create fear. Winning streaks create overconfidence. Fear makes you hesitant. Overconfidence makes you reckless. Most traders blow their accounts after a period of success, not failure, because success convinces them they have figured it out. And once that belief forms, discipline erodes. They increase position size. They loosen stops. They take marginal setups, all under the illusion of growth. But growth that is not earned through discipline is borrowed from the future. And the market always collects. Risk management must not change based on recent outcomes. Your best week should be traded exactly like your worst week. When you feel invincible, that is when your rules matter most. Now let's talk about the 10th law, one that ties everything together. Risk must be measured in percentages, not money. Money triggers emotion. Percentages maintain objectivity. When you think in currency, you attach meaning to outcomes. When you think in percentages, you think in process. Professionals never ask, how much money can I make today? They ask, how much am I willing to risk per idea? This shifts the focus from outcome to execution. A 1% loss is the same regardless of account size. It keeps the game fair, it keeps the math intact, and most importantly, it keeps your psychology stable. When risk is controlled, time becomes your ally. Compounding begins quietly, equity curves smooth out, and decisions become easier. But when risk is inconsistent, everything becomes reactive. Now understand this deeply. Risk management does not eliminate losses. It eliminates ruin. You will still lose trades. You will still have drawdowns. You will still feel discomfort, but you will remain functional. And functionality is what allows learning. A trader who survives learns. A trader who blows up only repeats. This chapter should leave you with a new respect for restraint, because restraint is not weakness. It is mastery delayed. Most traders believe risk is only numbers, lot size, stop distance, percentage exposure. That belief is incomplete. The most dangerous risk in trading cannot be measured on a chart or calculated in a position size calculator. It lives in the mind, and because it is invisible, it is rarely respected. This chapter is about emotional risk, the kind that ruins execution, distorts perception, and causes traders with solid models to behave like beginners. You can have perfect analysis and still lose money consistently if emotional risk is unmanaged. The market does not beat most traders. They beat themselves in moments of pressure. Emotional risk shows up in very specific ways, not randomly, not mysteriously. It appears when expectations collide with reality. This leads us to the 11th law. Expectation is a form of risk. The moment you expect a trade to work, you are emotionally invested. An emotional investment changes behavior. You manage trades differently when you expect to win. You hesitate to take stops. You move targets prematurely. You interfere. Expectation creates attachment. Attachment creates distortion. Professional traders have intent, not expectation. They intend to execute a model. They intend to manage risk. They intend to follow rules. They do not expect outcomes. Expectation says, this should work. And so intent says, I will execute regardless. That difference determines survival. Now understand this. Hope is not neutral. Hope is risk. Hope keeps traders in losing trades longer than logic allows. Hope whispers that price will come back. Hope reframes invalidation as temporary discomfort, but the market does not respond to hope. It responds to liquidity and order flow. Once a level is invalidated, staying in is no longer trading. It is bargaining with randomness. This leads directly into the 12th law. A losing trade, managed well, is a success. Most traders cannot accept this. Their identity is tied to winning. And because of that, they never develop emotional maturity. A well-managed loss protects capital and confidence. A poorly managed win damages discipline. Over time, discipline matters more. Professional traders review losses differently than amateurs. They do not ask, why did this lose? They ask, did I execute correctly? If the answer is yes, the trade was successful regardless of outcome. This reframing is critical. Because if you only feel successful when you win, you will always chase validation. And validation is emotional leverage the market uses against you. Now let's talk about execution risk, which is where emotional risk expresses itself. And this brings us to the 13th law. Execution errors compound faster than market losses. Missing entries, chasing price, closing trades early, hesitating on valid setups. These are not small mistakes. They are structural leaks. One execution error rarely hurts. Repeated execution errors quietly destroy expectancy. Most execution errors come from fear of loss or fear of missing out. Both are emotional states. Both are forms of unmanaged risk. When fear dominates, you underperform your system. When greed dominates, you overexpose. The solution is not more analysis. It is tighter emotional structure. This is why professionals trade fewer setups than they could. They do not maximize opportunity. They maximize clarity. Clarity reduces emotional noise. Noise increases risk. Which brings us to the 14th law. Overtrading is emotional risk disguised as productivity. Many traders believe more trades equal more money. In reality, more trades often equal more emotional fatigue. Fatigue leads to shortcuts. Shortcuts lead to mistakes. Mistakes lead to drawdowns that feel unfair. Overtrading usually comes from one of two places: boredom or desperation. Neither belongs in trading. Trading is not entertainment. It is execution under constraint. If you need excitement, the market will happily provide expensive lessons. Now let's address the most dangerous emotional pattern of all, which leads us to the 15th law. Revenge trading is a risk management failure, not a psychological flaw. Revenge trading happens when loss exceeds emotional tolerance. That means risk was too large relative to psychological capacity. This is not a character problem. It is a design problem. If one loss makes you want to get it back, your risk was too high. Period. Risk must be small enough that losses are emotionally absorbable. When losses are absorbable, you remain rational. When they are not, you become reactive. Professional traders design risk to protect emotional capital as much as financial capital. Because once emotional capital is gone, logic cannot function. This chapter should leave you with one realization. If you cannot execute your plan during stress, your risk is too large. Reduce risk until execution becomes boring. That boredom is the foundation of consistency. By now, you understand the essential truths. Risk is real. Losses are inevitable. Emotions are lethal. But understanding alone is insufficient. Knowledge without application is a debt that compounds with interest. This chapter is about structure, about building a risk framework that allows survival, growth, and compounding edge. The 16th law of risk management is foundational. Frameworks are superior to rules. Most traders operate under rules. Never risk more than 2% or always set stops. Rules are rigid, reactive, and often abandoned under pressure. A framework is different. A framework encompasses process, mindset, and mathematics. It tells you not just what to do, but why, when, and how. It allows adaptation without compromising integrity. Your framework is your map in a probabilistic world. Without it, you wander. With it, you navigate. At the core of a framework lies position sizing, which is governed by the 17th law. Risk per trade is a percentage of equity, not ego. We discussed percentage risk in Chapter 2, but now it must be contextualized within a framework. Position sizing should never be arbitrary or influenced by recent wins or losses. Each trade is a calculated exposure. Each exposure preserves your ability to trade tomorrow. That is the first priority. Growth is secondary. This is where most traders fail. They confuse ambition with capacity. They risk too much too soon, thinking their skill justifies aggression. Skill without risk control is a formula for rapid failure. The 18th law addresses the invisible force behind these failures. Market conditions change, but risk tolerance must not fluctuate with emotion. Traders often increase risk in hot markets or reduce it in boring markets. Both approaches are traps. The market does not owe consistency. You must create consistency within yourself. Your framework should dictate maximum allowable risk per trade based on account size, regardless of market excitement. Emotional interference is not optional, it is a design flaw to be removed. Now we arrive at the 19th law, which binds all the prior principles together. Journaling and reflection are the ultimate risk control tools. A framework without feedback is blind. Most traders fail, not because of the market, but because they cannot recognize patterns in their own behavior. Track every trade, entry, exit, position size, psychological state, rationale, and outcome. Analyze not only what happened, but why you felt and acted the way you did. This practice reveals emotional risk, execution errors, and deviations from process that might otherwise remain invisible. The insights gained are more valuable than any single technical indicator. Next is the 20th and final law. Survival is the ultimate compounding strategy. All the previous laws converge to this point. If you remain in the market, you have a chance to compound skill and capital. If you do not, nothing else matters. Patience is not passive. It is proactive risk management. Boredom is not weakness. It is consistency in action. Losses are not punishment. They are tuition in the school of probability. This law is both simple and profound. Protect your capital. Protect your mind. Execute your process consistently. The market will reward time and discipline more than intuition or prediction ever will. Now, let's combine all 20 laws into practical application. Predefine risk before every trade. Accept losses as part of the process. Keep risk consistent relative to equity. Avoid overtrading. Treat drawdowns as neutral events, not catastrophes. Measure risk in percentages, not currency. Maintain emotional discipline above all. Journal every trade to monitor both behavior and outcome. Understand that expectancy, not win rate, governs profitability. Prioritize survival over ambition. When these principles are embedded in habit, trading becomes less about prediction and more about execution. You stop fighting the market, you start respecting it, and in that respect, true compounding of both skill and capital occurs naturally. Finally, understand this. The market will always test you. It will challenge your patience, your discipline, and your psychology. But when risk is managed properly, nothing the market does can break you. You survive, you learn, and you grow. Risk management is not optional. It is the only edge that matters in the long run. Master it, and the market becomes a partner, not an adversary. Fail to master it, and the market will take everything without remorse. At this point, all 20 laws, from defining risk and respecting drawdowns to mastering emotional control and creating a resilient framework, form a cohesive system, one that separates professionals from amateurs, survivors from casualties,